Okay, so forget trying to pick the next it stock, forget drowning in complex charts. So much investing advice today is either way too complicated or, let's be honest, just a sales pitch in disguise. The big financial firms want you to think that building wealth is some dark art, a secret only the gurus on Wall Street understands. They make money off complexity, they profit from your confusion. But what if I told you that was a lie? What if you could build a powerful wealth generating portfolio with just 3 simple investments? A portfolio that could not only put you on the path to a 7-figure retirement, but do it without the stress, the fees, and outright gambling. This is the exact blueprint. I'm not talking vague theories, I'm just giving you specific actionable ETF tickers. This is a strategy so simple and so effective it almost feels like cheating. So stick around because this might just change how you think about investing forever. Let's just call it what it is. Why does investing feel like a full-blown anxiety attack? You open your phone and it's a firehouse of contradictory headlines. This stock is a rocket to the moon, sell everything, the sky is falling, you need to be in crypto, no gold, no Lithuanian small cap stocks. It's a 24/7 carnival of noise designed to make you feel like you're always missing out. This chaos usually pushes you into one of 2 traps. The first one is analysis paralysis. You're so swamped up by the thousands of stocks and funds that you just freeze. You do nothing. Your hard-earned money gets eaten alive by inflation in a savings account while you wait for the perfect moment to invest that, spoiler alert, never actually arrives. The second trap is even worse. You start gambling. Instead of investing, you jump into a hot tip from your cousin, you FOMO into some crypto you don't understand, or you try to time the market, usually buying high in a panic and selling low in a bigger panic. That's not a wealth plan, it's a quick trip to the casino where the house always wins. The financial industry loves this, by the way. Every trade you make lines their pockets with fees. But there is a third way. It's a path forged by one of the greatest investing minds ever, John Bogle, the founder of Vanguard. His philosophy was brilliantly simple. Instead of trying to find the one magic needle in the haystack, you just buy the whole haystack. Stop trying to beat the market and paying absurd fees to fund managers who rarely do. Instead, just match the market's return at the lowest possible cost. This is the heart of the passive index fund investing, and it's the foundation of my 3 ETF strategy. By the way, this is not financial advice, I'm not a financial advisor, this is educational and entertainment purpose only. The genius of this approach is that it defeats the 2 biggest enemies of your portfolio, high fees and your own emotions. Low cost index ETF means you keep more of your money working for you, and by automating your investments into a simple steady plan, you're far less likely to make panicked moves based on market noise. You just stick to the plan. This isn't a get rich quick scheme, it's a get wealthy for life strategy. So let's build this powerhouse portfolio. We are going to construct a complete US focused portfolio using just 3 ETFs. Each one plays a critical distinct role. Together they create a simple, robust and dirt cheap machine for building long-term wealth. And you can replicate this in other countries as well, just find the ETFs that are the equivalent. Okay, so let's start with the foundation of our entire portfolio. This is the bedrock. Its job is to give you a broad, stable and reliable growth by owning a piece of the most powerful economic engine in the world, the US stock market. For this, we turn to an S&P 500 index fund. I'm sure you've heard of it. My example ticker for this is the Vanguard S&P 500 ETF, or VOO. So what exactly is VOO? Well, imagine buying one single thing that instantly makes you a part owner of the 500 largest, most influential companies in America. With just one click, you own pieces of giants like Nvidia, Microsoft, Apple and Amazon, plus hundreds more across every industry imaginable. Tech, healthcare, banking, you name it. This is the buying the haystack. You're not betting on a single horse, you're betting on the whole American race. Why is this our foundation? Well, 3 simple reasons: diversification, performance and rock bottom cost. I mean, first, instant diversification. The classic rookie mistake is putting all your money on one company. If it goes south, you're wiped out. VOO solves that immediately. With 500 companies, if 1 or 2 stumble, it barely makes a dent in your overall investment. It's the ultimate safety in numbers. And second, historical performance. The S&P 500 has been a wealth creation engine for generations. Now, past performance is never guaranteed, but over the long haul, the index has historically delivered average annual returns of around 10%. It weathers recessions, recovers from crashes, and keeps chugging upward with the economy. Third, and this is the real kicker, the cost. The expense ratio for VOO is a microscopic 0.03%. Let me translate that. For every $10,000 you invest, you're paying a measly 3% a year. That's it. Compare that to active funds that can change 1% or more, a difference that can literally cost you hundreds of thousands of dollars over your lifetime. This was Bogle's gospel. Costs are everything, and VOO is the gold standard of low cost investing. This one ETF gives you a powerful core holding in the American economy, but to really get this portfolio cooking, we need to add a little bit of spice. Okay, so we've got our stable base, now let's add the turbocharge. This is the growth engine of the portfolio, designed to capture the explosive potentials of the world's most innovative companies. While our Our S&P 500 fund gives us broad stability. This second fund is more concentrated on the companies actively building the future. For this job, we'll use an ETF that tracks the Nasdaq 100 index. A fantastic low-cost choice is the Invesco Nasdaq 100 ETF with the ticker symbol QQQM, 3Q and 1M. What's the Nasdaq M100? Well, it's an index of the largest non-financial companies on the Nasdaq exchange. Basically, the major leagues of innovation. These are the power players behind artificial intelligence, cloud computing, EVs, and streaming. The holdings in QQM are a who's who of modern tech. Nvidia, Apple, Microsoft, Amazon, and Meta are all at the top of the list. So why add QQQM? It's about injecting a targeted dose of high growth potential. First, it gives you a concentrated exposure to innovation. VOO holds tech companies, sure, but it also holds slower growing banks and utilities. QQQM strips those away to focus on high octane growth sectors. Historically, this has paid off. The Nasdaq 100 has a track record of outperforming the S&P 500 over the long stretches, though it absolutely comes with more volatility. Second, it's the perfect complement to VOO. VOO gives us the whole market, while QQQM tilts us toward the tech and consumer sectors, the engines of modern growth. It's a 1-2 punch that lets you capture the market's steady climb while giving you a bigger piece of the fastest growing action. And let's talk about why QQM specifically. It's designed for long-term buy and hold investors. It has a low expense ratio of 0.15%, and it's basically the mini version of its more famous sibling QQQ. The lower share price makes it way more accessible for just people starting out or investing a set amount each month. It holds the same stock as QQQ, but is built for the everyday investor. Now, be warned, this ETF will be wilder ride than VOO. When tech is hot, QQQM will likely soar higher than the S&P 500, but when tech takes a dive, it will probably fall harder. That's why it's not our only fund, it's the performance-focused engine attached to our reliable foundation. But to make this portfolio truly resilient, we need one more piece. We have our broad market foundation with VOO and our high growth engine with QQQM. It's time for our final piece, the stabilizer. This ETF's job is to threefold: generate a steady stream of passive income, provide a defensive cushion when the market gets rocky, and anchor our portfolio in solid value priced companies. For this critical role, one of the absolute best in class ETFs is the Schwab US Dividend Equity ETF, ticker symbol SCHD. SCHD isn't your average dividend fund chasing risky high yield stocks. It's smarter. It tracks the Dow Jones US Dividend 100 index, which screens for about 100 US companies based on our 4 key things: high dividend yield, a history of dividend growth, strong return on equity, and healthy cash flow. In plain English, SCHD finds financially solid quality companies that not only pay you a nice dividend today, but have a proven track record of increasing that dividend year after year. We're talking about cash flow machines like Home Depot, Coca-Cola, and Amgen mature, stable businesses that consistently churn out profit. So why is SCHD the perfect final ingredient? Well, first, it's an income machine. While you're working, you can set the dividend to automatically reinvest, which is like putting your wealth creation on steroids. The dividends buy more shares, which then generates more dividend, a true wealth snowball. Then in retirement, you can just flip a switch and start living off that income stream without having to sell your core investment. Second, it's a defensive powerhouse. The types of companies SCHD owns, strong dividend paying value stocks, tend to be less volatile than growth stocks during a market crash. While QQQM might be taking a nosedive, the steady income and stable nature of SCHD can often blow and reduce the overall whiplash in your portfolio. That balance is the key to staying sane and investing for the long run. Third, it diversifies our strategy. So far, we've had a broad market exposure from VOO and growth tilt from QQQM. SCHD adds a strong value and quality factor. Some years growth stocks are the stars of the show, other years value stocks take the lead. By owning both, you ensure that part of your portfolio is likely performing well no matter what the market is doing. And with an expense ratio of just 0.06%, SCHD is an incredibly cheap way to add income and stability. Together, these three, VOO, QQQM, and SCHD, create a beautiful balanced team. You have the market, you have a high growth, and you have income and defense. So we have our dream team: VOO for the foundation, QQQM for the growth, SCHD for income and stability. The final and most critical question is, how do you mix them? This isn't a one-size-fits-all recipe. It really depends on your age and how much risk you're comfortable with. Let's walk through a few simple blueprints for this. Let's start with looking at the aggressive growth model, perfect for your 20s and 30s. When you're young and your greatest asset is time, you can take on more risk for potentially higher returns. I would say here 50% VOO and 30% QQQM and 20% in SCHD. This mix is built for speed but is still well diversified. You have a decade to let it compound, and this allocation is designed to make the most out of them. Then we have the balanced growth growth model, great for your 40s and 50s. As you get closer to retirement, you might want to dive back to risk a bit and focus more on preserving what you've built. 50% VOO, 20% QQQM, and 30% SCHD. This model still has great growth potential, but adds a bit more of a cushion, providing a smoother ride as your nest egg gets bigger. And then we have the instability model for those nearing or in retirement. At this stage, the game changes from growing your money to making it last and paying your bills. 40% VOO, still a solid core to outpace inflation over the long retirement, and 10% QQQM, just enough to keep a small stake in innovation, and 50% in SCHD. Now the star of the show, designed to generate a reliable income stream to live on. These are just starting points. The real magic is understanding what each ETF does and adjusting the dials to fit your own personal comfort level. Now for the fun part, the payoff. What could this simple strategy actually do? Let's be clear, these numbers are just a hypothetical example based on historical averages, not a promise. But let's say you're 30 and you start from scratch and you invest $500 a month using the balanced growth model. Based on the long-term historical average returns of a similar blended portfolio, which is conservatively in the 10 to 12 range, here's what could happen. By age 40, your portfolio could potentially hold around $105,000 by the age of 50. That could grow to over $380,000, and by the age 60, you could be looking at a portfolio worth over $1.1 million. Let that sink in. A potential 7-figure portfolio from just $500 a month in 3 simple funds without ever picking a stock, timing the market, or paying a fortune to some expert. That is the life-changing power of keeping it simple, staying consistent, and letting compound growth do the heavy lifting. So that's it. Investing doesn't have to be a complicated, stressful mess. By combining a foundational S&P 500 ETF like VOO, a growth engine like QQQM, and an income stabilizer like SCHD, you can build a powerful low-cost portfolio designed for long-term success. This strategy puts you back in the driver's seat. It minimizes fees, harnesses the power of America's greatest companies, and automates your wealth building. It gives you a broad market exposure, a tilt toward innovation, and a stream of dividends for the fans. It's not just about buying ETFs, it's about buying a disciplined, proven system for financial freedom. For even greater diversification, many investors also add an international ETF to get exposure to markets outside the US, which can be a fantastic fourth step. Forget the noise and the hype. The real secrets to investing was never a secret. It's having a simple plan and a discipline to stick with it. If this video helped simplify investing for you, do me a favor and hit that like button and subscribe for more no-nonsense financial content. And now I want to hear from you. What are your go-to ETFs? Do you already use a 3-fund portfolio? Drop a comment below. Thanks for watching, and I'll see you guys in the next video.